What if the quietest line of data on Wall Street turns out to be the loudest alarm bell for your wallet? The Federal Reserve's favorite inflation gauge, the Personal Consumption Expenditures Price Index, or PCE, just nudged higher. And that subtle move could upend interest rate bets, rattle stock valuations, and change what you pay on everything from mortgages to credit cards. Today we're unpacking exactly why that slight rise matters, what's driving it beneath the surface, how Chair Jerome Powell and the Federal Reserve might respond, and the concrete steps you can take right now to protect your money. Stay with me until the end, because the most important twist isn't in the headline number, it's S in the path this sets for the next few months, and what it forces the Fed to choose when the numbers and the narrative collide. Inflation isn't just an abstract macro chart. It is the temperature of everyday life. How fast your purchasing power evaporates, how quickly your raises feel smaller, and how much lenders demand to loan you money. When that temperature rises, even a little, the reflex of the financial system is to reach for the monetary thermostat. Interest rates. A slight uptick in core PCE, the version that strips out food and energy to reveal the underlying trend, signals that price pressures are proving sticky. That matters because the Fed's credibility hinges not only on hitting 2% on paper, but on convincing consumers and markets that 2% is where we, going to live. If inflation resists, even modestly, the cut-soon narrative that markets love has to be repriced, and the cost of borrowing you feel in your daily life can stay high longer than you planned. Let's decode the tool the Fed actually watches. The PCE index is built by the Bureau of Economic Analysis and updated monthly in its Personal Income and Outlays report. Unlike CPI, which uses a relatively fixed basket of goods, PCE is chain-weighted, so it adapts when consumers substitute, say, switching from beef to chicken. That makes PCE better at capturing real-world behavior, and, historically, it tends to run a bit cooler than CPI. Policymakers emphasize the core PCE because food and energy are volatile. Removing them helps isolate persistent trends. If you've ever wondered why 0.1% in core PCE moves markets more than a big splashy headline elsewhere, this is why. It's the measure the Fed itself emphasizes when it sets policy. The PCE index is built by the Bureau of Economic Analysis and updated monthly in its Personal Income and Outlays report. Bureau of Economic Analysis. Here is where the data stands heading into late August 2025. The BEA's latest release showed headline PCE up 2.6% year-over-year in June, from 2.4% in May, with monthly inflation running at 0.3% in June, after 0.2% in May. Bureau of Economic Analysis. Meanwhile, consensus is bracing for a modest firming in the coming print, and producer prices, the pipeline of costs before they reach consumers, jumped 0.9% in July, the biggest monthly rise in 3 years. Reuters. That PPI surge, with gains in both services and goods, is the kind of upstream pressure that often bleeds into consumer prices with a lag. It's not a guarantee of hotter PCE, but it is a warning that the disinflationary glide path isn't a straight line. In parallel, CPI's core measure showed a 3.1% year-over-year increase in July, a notch higher than June's 2.9%, reinforcing the idea that services inflation remains sticky, even as goods price growth cooled earlier in the year. Reuters. Against that backdrop, Jerome Powell used Jackson Hole to signal a dovish tilt. Risks to employment are rising, and the Fed will not ignore a softening labor market. Financial Times, AP News, Reuters. Traders rushed to price an elevated probability of a September cut. The dollar slipped and then struggled to recover. and Treasury yields moved lower on the expectation that policy easing is closer than previously thought. Yet here's the dilemma. Powell can nod to labor risks and still be cornered by the inflation data. If PCE refuses to behave, or if the breadth of inflation is widening, Powell's room to ease narrows quickly. It's a tightrope. Lean too far towards supporting jobs, and you risk reigniting inflation. Lean too hard against inflation at a moment when hiring cools, and you risk a sharper slowdown. The market wants clean answers. The data is delivering messy trade-offs. So what's feeding this stickiness? First, tariffs have crept back into the inflation narrative. Reuters. Even if core PCE excludes energy and food, imported goods costs flow into a wide array of categories, from appliances to capital equipment, and businesses eventually pass those costs along. Second, services inflation has been stubborn. Labor-intensive categories like healthcare, personal services, and parts of housing keep a floor under the trend. Third, supply frictions still flare. Shipping routes, redrawn sourcing strategies, and friendshoring add frictional costs that are small in isolation but meaningful in aggregate. Each of these forces acts like a tiny shim under the price level, lifting it just enough to complicate the Fed's job. A smart way to separate noise from signal is to look at breadth measures. Core PCE is the workhorse, but the Cleveland Fed ES inflation. Nowcasting and median and trimmed mean measures help show whether price pressures are narrow or broad-based. When median and trimmed mean move in tandem with core, that's usually a sign that inflation isn't confined to one or two hot categories. Recent nowcasts put monthly core PCE near 0.25%, hardly runaway, but not yet gliding to 2%, which underscores why each tenth matters. clevelandfed.org. The distinction here is crucial. At 0.20% month over month, you can annualize to a number starting with 2. At 0.30%, you're knocking on the door of 3 again. That arithmetic is why market pricing swings wildly on what looks like a trivial difference. Powell's dovish tone didn't emerge in a vacuum. Payroll growth has cooled from 2023's pace, job openings have normalized, and anecdotes of hiring freezes have multiplied. A softer labor market typically drains momentum from services prices, but the timing is uncertain, and this cycle has repeatedly surprised forecasters. The Fed's calculation is dynamic. If disinflation stalls while jobs weaken, officials face the uncomfortable choice of easing into sticky inflation or holding and risking a sharper growth downshift. The path they take depends on how convincingly PCE trends lower in the next 2 to 3 prints. That is why this slight rise matters. It threatens to push those prints in the wrong direction at precisely the moment the Fed had hoped to pivot toward easing. Here's the fork in the road almost nobody wants to consider. A short-lived lull in core CPI followed by renewed pipeline heat from PPI, and tariffs could yield a PCE sequence that runs just hot enough to spook the Fed from cutting in September, without being hot enough to justify a hike. That no man's land would leave risk assets adrift, valuations vulnerable, and retail borrowers stuck with higher-for-longer rates. If you think markets have already discounted that, ask yourself why rate-sensitive stocks whip around so violently on each data point. Price moves reveal positioning. The reactions tell you what's priced in and what isn't. The fact that a tenth can erase months of neat narratives should make you cautious about betting on straight-line outcomes. Let's translate the macro into line items you actually see. If cuts slip later into 2025, fixed-rate mortgages won't unlock as quickly as buyers expect. Affordability stays stretched. Inventory remains tight, and transaction volumes grind. For credit cards, variable APRs hovering near recent highs punish revolving balances, making every month of delay expensive. Auto loans and personal loans stay pricier too, especially for borrowers without pristine credit. On the saver side, high-yield cash remains attractive, but you need to think about how long that generosity lasts once the cutting cycle begins. Front-load your cash strategy while rates are still supportive. For renters, small increases in lease costs add up. Negotiated renewals and price shopping matter again. In short, a slightly stickier PCE can cost you hundreds or thousands of dollars over a year, depending on your debt profile. For equity investors, inflation's character matters more than the headline. Sticky services, cooling goods. Inflation tends to compress multiples for long-duration growth stories while helping near-term cash generators and certain cyclicals with pricing power. Energy and industrials may benefit if nominal growth holds and input cost pass-through persists. Financials live in the spread. A steeper curve can help, but credit quality is the swing factor. Tech's AI leaders remain earnings engines, yet their valuations are sensitive to the discount rate. The same earnings stream is worth less if the risk-free anchor refuses to fall. In fixed income, you can use duration as a dial. If you think the Fed blinks and cuts into a soft labor market, intermediate to long duration can rally. If you fear stickier PCE, keeps cuts off the table, hugging the front end and using T-bill ladders cushions you. And don't sleep on quality credit. Spreads can be your friend if the growth picture isn't deteriorating too fast. Here's a simple, professional-grade checklist to track from your phone. Start with BEA's PCE release dates and watch whether monthly core lands at roughly 0.2% friendly, 0.3% sticky, or 0.4% uncomfortable. Then look at the PPI surprise factor because anything notably strong in services raises a red flag for downstream PCE. Monitor the CPI-PCE wedge. When CPI cools but PCE stalls, services are usually to blame, so watch shelter and medical. Check the Cleveland Fed's nowcast in the week before each release. And finally, compare Powell AS tone against the Fed's summary of economic projections to see whether policymakers still imply multiple cuts or are clustering near one. Bureau of Economic Analysis, Reuters, clevelandfed.org. The discipline here is consistency. Follow the same breadcrumb trail every month, and the noise gets quieter. No one can forecast perfectly, but you can scenario plan. In a base case, core PCE glides down in fits and starts, averaging around 1/5 to 1/4% month over month into autumn. The Fed cuts once in September or November and then waits and risk assets chop but trend higher on earnings resilience. In a sticky case, core PCE prints closer to 0.3 repeatedly. PPI stays warm, tariffs seep through, and the Fed delays the first cut to year-end, leaving yields range-bound but elevated and equities derating modestly as multiples compress. In a reheat case, upstream cost pressure and wage inertia spill into PCE, with a couple of 0.4 prints forcing the Fed to skip cuts entirely as growth cools, credit spreads widen, and defensives outperform. And in an upside disinflation tail scenario, goods deflation reasserts itself, rents decelerate faster, services cool, and more than one cut arrives by year-end. Call it a low-probability Goldilocks, but you should still know what you'll do if it shows up. Reuters. 3 wildcards can scramble the script. First, policy changes. If tariffs escalate or broaden, import cost pass-through could offset goods disinflation longer than markets assume, complicating the downward trend in PCE. Second, data quality and revisions. Measurement issues, underfunded statistical work, or methodology changes can shift the trend in hindsight, altering how the Fed reads momentum. That is not conspiracy. It's the unglamorous reality of macro data. Third, global spillovers. A stronger than expected rebound in other regions, a commodity supply shock, or an abrupt currency move can tighten global financial conditions and lift headline inflation even if domestic demand cools. These aren't predictions. They're reminders that inflation is not only a domestic story. If Powell leans dovish but the numbers won't, what breaks first? The market's faith in cuts, or the Fed's patience with inflation? Tell me in the comments which you think blinks first, and why, because your answer shapes how you manage risk over the next 90 days. If investors push their hopes too far ahead of the data, the snapback can be brutal. If the Fed leans too hard into the softening labor argument before the PCE trajectory cooperates, credibility takes a hit, and long-term expectations can wobble. That is the tight spot officials want to avoid. Here's your practical step-by-step plan to turn macro noise into personal action. Start with a refinancing triage. List every liability with its rate term, whether it is variable and how sensitive the payment is to a small rate move. Attack revolving credit first, because your APR is essentially inflation plus a bank spread, and it compounds against you. Build or refresh a cash ladder so that 3 to 6 months of expenses sit across high-yield accounts and short T-bills, giving you liquidity and yield. Keep rolling maturities until core PCE convincingly heads to 2%. If your mortgage is adjustable, price out refinance scenarios at multiple rate paths. A 50 basis point surprise can mean hundreds per month. In your portfolio, use a barbell. Pair quality dividend growers, defensives with real pricing power, with selective growth where earnings visibility is strongest. Avoid over-concentration in the longest duration stories until PCE cools and the path to cuts is clear. Finally, audit your income sensitivity. If your job is cyclically exposed, pad your runway and upskill now. If you're in sticky services industries, you may have more bargaining power. Use it before hiring slows. Bureau of Economic Analysis. When the tape starts trading on PCE day, professionals watch 5 things and you can too. They look at the month-over-month core number versus consensus. They check revisions to prior months because those revisions can matter more than the print itself. They break down the services, goods split, to see where pressure sits. They keep an eye on Supercore, a proxy for wage-sensitive services that excludes housing. And they watch how the market-implied path of policy evolves in the 30 minutes after the release to judge whether the surprise proved sticky or faded. Then they overlay earnings revisions. Are analysts raising, flat, or trimming forward estimates? Valuation can stretch if earnings grow, but if rates rise and estimates fall, multiples compress fast. This is the dance between fundamentals and discount rates, and inflation is the DJ. In finance, stories travel faster than statistics. You will hear, inflation is back, and the Fed has won, in alternating breaths. The truth is, in the time series, a single 0.3% core PCE print does not doom the cycle, nor does one 0.1% miracle guarantee victory. Watch the 3-month and 6-month annualized rates. If they run at 2.5% to 3%, while the year-over-year flattens, the under-the-hood trend is still hot. If they sink to 2%, with breadth measures cooling, the case for easing strengthens. The discipline you need is to focus on the rolling trend, not the one-day headlines. Professionals live by that rule because it keeps them on the right side of probability, rather than the wrong side of a narrative. People love 1970s analogies, but this cycle is different. Back then, inflation expectations were unanchored, unions were stronger, and energy shocks repeatedly reset the price level. Today, expectations, so far, are better anchored, Globalization is evolving rather than reversing outright, and technology continues to exert disinflationary force in goods. Still, services are the battleground. If wage growth and shelter inflation decelerate together, disinflation resumes. If they don't, the resemblance to the 1970s will increase not because of oil alone, but because expectations can fray if the Fed appears to tolerate 3-ish inflation for too long. That is why Powell's messaging around patience and vigilance matters as much as the dots. Language shapes expectations, and expectations shape the slope of the disinflation path. Jackson Hole this year was a reminder that tone can move markets even before policy moves. Small businesses live where PCE becomes receipts. If you run a service firm, price discipline is your moat. Raise too slowly, and margins evaporate. Raise too fast, and churn rises. Tie adjustments to objective benchmarks, such as including CPI or PCE clauses in client contracts, to reduce friction. For inventory-based businesses, reprice faster than your suppliers requote you, and negotiate freight aggressively, because transportation swings can overwhelm your unit economics. For creators and entrepreneurs, align your content and marketing calendar with release dates, PCE, CPI, PPI, because search interest spikes on data days, and your audience will reward timely, actionable context. This is not just macro education. It is a strategy for revenue stability when the backdrop is noisy. Let's puncture a few myths that confuse even seasoned investors. Myth 1 says, core PCE excludes what I actually buy. But in reality, it excludes the most volatile categories to reveal the trend. Headline PCE still includes them, and policymakers watch both. Myth 2 claims, a tiny uptick doesn't matter. Yet policy pivots are marginal, and markets reprice on tenths, not whole numbers. Your mortgage rate moves on those tenths. Myth 3 insists, producer prices don't affect consumers anymore. But they do, with a lag that varies by sector. And July's broad-based PPI jump is precisely the kind of upstream pressure that later shows up in retail prices unless demand collapses. Myth 4 says, if the Fed cuts, inflation must be conquered. But cuts can arrive because growth is deteriorating, not because inflation is vanquished. The sign of the cut matters as much as the cut itself. Reuters. Imagine a 2-income household with 1 adjustable-rate mortgage, 2 car loans, and savings sitting in a high-yield account. In the first path, core PCE cools toward 0.2 month over month. The Fed cuts in September. And again by year-end, the mortgage resets lower, and the freed-up cash flow lets them knock down card balances. In the second path, core PCE runs at 3 to 0.4 into autumn. The Fed delays, the ARM resets higher, card APRs bite harder, and the car payments feel heavier as insurance premiums climb. The same household is either compounding relief or compounding stress, based on a sequence of monthly prints that most people barely notice. That's the hidden leverage of macro. Small differences in trend stacked over time make big differences in outcomes. Cycles turn, but good habits compound. Automate savings so you do the right thing on schedule rather than on emotion. Diversify by risk, not just by ticker symbol, so that what you own responds differently to the same shock. Focus on fees you can control, expense ratios and transaction costs, because they subtract from returns every year. Write a simple investment policy statement that you can read in a panic and still follow. Keep a small, regret journal of hurried decisions so that the next time headlines scream, you can see how the last impulse trade worked out. The point isn't to be macro-omniscient, it's to be behaviorally prepared. We are reheading toward a binary moment. Either the inflation trend reasserts its downward slope and unlocks a gentle easing cycle, or it refuses to budge, and the Fed's balancing act becomes a slow march across a narrowing beam. You don't need perfect foresight to thrive across both states. You need preparation sized to your reality, not someone else's model. For most people, that means reducing expensive revolving debt, right-sizing cash, owning quality businesses or funds that can protect margins, and avoiding the temptation to time every tick of policy expectations. The reason this slight rise in PCE matters is that it forces better questions. What if easing comes later than planned? What if the first cut isn't the bullish panacea? What if tariffs or upstream pressures keep the glide uneven? The investors and families who ask those questions now will make fewer rushed decisions later. Here's a deeper dive into how PCE is built and why it often runs cooler than CPI, which helps to explain the communication gap you see online. There are three key mechanics. First, the weighting of categories differs. Healthcare carries more influence in PCE because it captures expenditures made on behalf of households by employers and the government. Second, substitution means that when relative prices change, consumers shift their baskets. PCE's chain weighting captures that behavior in real time, while CPI's fixed basket updates less frequently and can lag. Third, scope. PCE covers a broader universe of expenditures, which can make it a better macro barometer, even if it sometimes feels less relatable to a single shopper. Experience. Understanding these differences lets you read both gauges without being whipsawed by their occasional divergence. The journey from the inflation spike of 2022 to today's higher but falling gauge zone was driven by unwinding supply snarls, aggressive rate hikes, and a normalization in goods prices. By mid-2025, headline PCE had cooled to 2.6% year-over-year in June, up from 2.4% in May, a reminder that progress is rarely linear. The month-on-month pace, at 0.3% in June after 0.2% in May, keeps the 3-month annualized rate hovering above the ideal 2% trend. Meanwhile, CPI, constructed differently, showed core at 3.1% year-on-year in July, even as headlines steadied. Bureau of Economic Analysis, Reuters. That divergence fuels debate on whether the Fed should lean on one measure more than the other. But the answer has always been, use both and read the details, because the composition of inflation tells you far more than the single number at the top of the table. Why did that 0.9% pop in producer prices grab so much attention? Because the PPI is the economy's upstream checkpoint. When wholesalers and producers face a synchronized rise in both goods and services costs, they triage, absorb some pressure, re-engineer processes, and, when margin math demands, pass costs on. The pass-through is neither instant nor guaranteed. It depends on competition, inventory levels, and demand elasticity. But history says a broad-based PPI surprise is a headwind for downstream measures like PCE, especially when services components are the driver. That is why investors reacted so sharply to July AS number, even though consumers won to see the full effect immediately. It is a heads-up that the pipeline is warming again. Reuters. Jackson Hole is less about hard guidance and more about narrative calibration. Powell ES 2025 remarks leaned dovish compared with earlier posture. He emphasized rising risks to employment and the importance of being data-dependent, which markets heard as permission to price a September cut. The immediate reaction, stocks up, yields down, a weaker dollar, told you positioning was leaning that way. Still, a dovish tone is a bridge, not a destination. Between the bridge and the shore stands the PCE data, and if that data doesn't cooperate, the market has to walk back across the bridge the hard way. That is why it pays to listen to the tone and read the tables, not just one or the other. Financial Times, AP News, Reuters. Shelter is the loudest ghost in the inflation machine. Market rents can cool for months before the official shelter components in CPI and the implicit housing services in PCE fully reflect that move, because leases roll slowly. In 2023 and early 2024, that lag worked in the Fed's favor as new lease data pointed down. By mid-2025, the steepest declines had ebbed. The shelter disinflation tailwind is smaller, leaving core services more exposed to wages and non-housing services dynamics. If you're watching for the next leg lower in core PCE, this is the channel to monitor. It is also the channel that makes cuts tricky. If shelter disinflation is fading while wage-sensitive services refuse to cool, the Fed must be sure the broader trend is intact before easing. A persistent debate lives inside every FOMC meeting. Are wages rising faster than productivity? If unit labor costs keep climbing, service providers face a choice between margin compression and price increases. Analysts often focus on supercore inflation, core services excluding housing, as a rough proxy for wage-sensitive categories. If supercore runs hot while goods stay cool, that's a sign the labor market is still too tight. Powell's dovishness reflects signs of cooling. Slower job gains, fewer openings, some easing in quits. But the question is whether it's cooling enough. The Fed can accept a slow approach to 2% if the path is clear and the labor market is intact. It cannot accept an ambiguous path and a fraying jobs picture at the same time. 0.1% on core PCE may not sound like much, but discount rates are the gravitational constant of finance. Equity valuations sit on top of risk-free rates plus term and equity risk premia. If the market moves from pricing 2 cuts to 1, or from 1 cut to 0, the present value of far-out cash flows falls. Duration-heavy assets feel it first. Software, speculative growth, early-stage biotech. On the flip side, short-duration cash flows. Think staples, some insurers, midstream energy, can hold up better precisely because they depend less on a long chain of future assumptions. If you want to see discount rates at work, chart valuation multiples against real yields. When real yields climb, multiples often sink, even if earnings are holding. If you want a market-based read on inflation expectations, watch Treasury inflation-protected securities and the break-even, the yield gap between a nominal Treasury and a TIPS of the same maturity. Rising break-evens often mean investors demand more compensation for inflation risk. Falling break-evens imply confidence in disinflation. But be mindful of liquidity quirks. In risk-off episodes, break-evens can fall even when near-term inflation is hot, simply because investors scramble for plain vanilla duration. Used properly, break-evens and real yields can tell you whether the market thinks the Fed has regained control or is still negotiating with the data. Rates don't just live in the bond market, they live on your statement. Banks and card issuers reprice variable rate debt quickly. Small businesses' rolling lines of credit are the canaries. When working capital becomes expensive, hiring plans slow, and inventory turns stretch. That bleeds into services inflation with a lag, but it also pressures earnings. If Powell delays cuts into late 2025, expect credit conditions to remain tight for longer, even as headline inflation hovers near the high 2s. That mismatch is uncomfortable for Main Street. Prices aren't falling, but financing isn't easing either. Many investors treat rate cuts as an automatic risk-on green light. Context matters. A cut because inflation is convincingly at target is very different from a cut because the labor market is cracking. Powell aids Jackson Hole, emphasis on employment risks, tells you the Fed's reaction function has 2 arguments: inflation and jobs. If PCE is sticky while jobs weaken, the Fed may still cut. but that cocktail is not obviously bullish for earnings. Watch the post-meeting press conference language to parse which side of the mandate is doing the talking. Phrases like confidence in inflation returning to target are the verbal breadcrumbs of an easing path that the Fed believes it can defend to the public and to markets. Here's a granular personal finance playbook for the next 90 days. If you carry credit card balances, call your issuer and ask for a rate review. Successful requests can shave real dollars over a year. If you're within 6 to 12 months of a potential home purchase, run scenarios at mortgage rates 50 to 100 basis points above and below your base case, and set a walkaway price that keeps your payment under a fixed share of take-home pay. For emergency funds, split cash between an online bank and laddered T-bills so you're not captive to any single institution and you get a market rate. For investing, pre-commit to rebalancing on a schedule rather than in response to headlines. The discipline of buying what S down and trimming what S up often beats the ad hoc alternative when volatility returns. On PCE morning, act like a pro. Start with the press release table that shows monthly and 12-month changes for headline and core. Scan contributions to see whether goods or services are doing the lifting, and within services, focus on housing, healthcare, and financial services. Check revisions to prior months. A downward revision to a hot prior print can ease pressure even if the current print is neutral. Then triangulate with the Cleveland Fed's nowcast from the day before. Was the surprise within the model's typical error band, or truly off consensus? Finally, watch how markets digest the news over the next hour. Does the initial move hold, reverse, or accelerate? The pattern often tells you whether traders see the print as trend-changing or just noise. If you manage a business or a household, reduce decision fatigue by pre-committing to thresholds. For example, decide that if 3-month annualized core PCE rises above a certain level, you throttle hiring or large purchases by a set amount, or that if yields drop below a given line in the sand, you accelerate a refinance. Turning macro into rules shields you from headline whiplash. Share your calendar of releases with your team or family so everyone knows why a particular week feels risk-on or risk-off. Clarity is a free hedge that pays in calmer decisions. Inventories are the unsung drivers of near-term inflation. When shelves are bloated, discounting accelerates, and goods inflation cools. When inventory is lean and replenishment costs are rising, sticker prices stick. Track corporate earnings calls for inventory language. It is often the first place you'll hear whether PPI heat is being absorbed or passed along. Combine that with freight and shipping metrics to anticipate where PCE goods components will go next. The macro reports come monthly, but the micro tells you early. Build yourself a simple if-then checklist so you aren't improvising the next time a headline hits. If core PCE's 3-month annualized pace falls to roughly 2% and unemployment is stable, assume the Fed will validate easing bets and adjust your duration and equity exposure accordingly. If core PCE stalls near 2.8–3.0%, while jobless claims stay low, expect policy patience to lengthen and plan for choppy equities. If PPI services runs hot for 2 consecutive months, raise your inflation vigilance and shift some portfolio beta toward quality. And if Powell's press conference emphasizes repeated confidence that inflation is returning to target, that's your signal that cuts are getting institutional support, even if each monthly print is imperfect. Behind every index, there's a human story. The first-time buyer whose rate lock expires a week too early, the retiree whose bond ladder finally yields enough to sleep, the founder balancing payroll and pricing power. Inflation data isn't a scoreboard. It's a map of trade-offs. The destination we all want, stable prices and full employment, arrives by inches, not miles. Your job isn't to predict each inch. It's to keep moving forward with intention. That means knowing where you are in the cycle, how exposed you are to its bumps, and what you will do before the next bump arrives. So, I want your take in the comments. If the next PCE print lands a tenth hotter than consensus, does Powell stick with the dovish tilt or blink and push the first cut to year-end? Tell me which way you lean and why. If you want a follow-up, where we road test sample portfolios for both outcomes, hit subscribe, tap the bell, and share this with someone who keeps asking what PCE even is. Because sometimes the smallest number on the calendar is the loudest signal your money will hear. And the investors who listen without panic tend to be the ones still compounding when the noise fades.